the recession would cause silver to collapse relative to gold, and that's what happened. But then it quickly unwound. So to echo what you're saying here, the gold silver ratio goes to 104, and it goes to 104 pretty steeply in what month is that?
End of March. So
Starting in March. So from March to April, the bullion banks did nothing but buy gold and sell silver, as well as their clients, as well. So that was basically them throwing in the towel on gold. We can't keep it down anymore, at least for the last, say, 7 days. Gold has been, I'm simplifying, been unchanged. Silver has been up 12%, and copper has been up.
The precious metals market is experiencing a dramatic realignment that veteran traders are closely watching for broader economic signals. Vince Lanci, a seasoned commodity analyst and hedge fund manager with over 3 decades of experience in metals and energy trading at his firm Echobay Partners, has identified a sharp shift in trader positioning that caught many market participants off guard. Vince Lanci highlights an unusual pattern in the metals complex over the past week. Gold stayed relatively flat, silver surged 12%, and copper rose 3 to 4%. He explains that this move caught traders off guard. Many had gone long gold on tariff concerns while shorting silver expecting a recession. As prices moved against them, those positions quickly unraveled, forcing a scramble to adjust. Gold's momentum eventually caught up, with prices surging to $3,377, marking a one-week high. The precious metal continues to serve as a safe haven asset during times of economic and political uncertainty. Silver's performance was equally notable, with prices climbing to $36.42. The white metal benefited from a weakening US dollar, declining Treasury yields, and robust industrial demand. The most striking development, however, is the gold-to-silver ratio reaching the psychologically significant 100-to-1 level. This means that 1 ounce of gold now equals the value of 100 ounces of silver, representing a dramatic disconnect between the two precious metals. According to Lanci, when this ratio climbed above 100 during the COVID-19 pandemic, it served as a clear signal of deep recession conditions, characterized by extreme risk aversion. The historical significance of this ratio cannot be understated. The last time it reached these levels was in March 2020, during the initial COVID-19 market crash. What followed was remarkable. Silver prices more than doubled within just 4 months as the ratio normalized. Before the pandemic, such extreme levels had been reached only once since the early 1940s, a period when the United States was emerging from a prolonged recession while much of the world was descending into global conflict. Before we dive into the video, make sure to subscribe to our channel, hit the bell icon so you don't miss any updates, and share this video with anyone who might find it valuable.
When you see when the gold silver ratio went above 100, let's say during COVID, that was a sign that we're in a gross recession of risk, and that recession is going to. I know you're going to pull the chart up. The recession would cause silver to collapse relative to gold, and that's what happened. But then it quickly unwound. So to echo what you're saying here, the gold silver ratio goes to 104, and it goes to 104 pretty steeply in what month is that?
end of March. So
Starting in March. So from March to April, the bullion banks did nothing but buy gold and sell silver, as well as their clients, as well. So that was basically them throwing in the towel on gold. We can't keep it down anymore, at least for this. If you look at the behavior of not just gold and silver, but gold, silver, and copper, you'll see that. That's not an easy chart to put up, but as for the last, say, 7 days, gold has been, I'm simplifying, been unchanged. Silver has been up 12%, and copper has been up 3 or 4%. And the reason for that is all these guys got caught off sides. They're long gold. Like here's the story that makes sense. They're all long gold, worried about tariffs. They're all short silver, thinking we're going to have a recession. And then Trump starts having his, tying back to our first topic, Trump starts having conversations with China, and now they're like, oh, the economy might be okay. We got to cover our silver because that's an economic metal. We've got to cover our gold. Well, half of them are long, copper. We have to cover our copper, but half of them are long copper anyway. But everyone is selling gold, not short, getting out of longs, and everyone is covering shorts and silver. And so you're looking at the gold-silver ratio almost be like a tariff barometer. Tariffs, yes. goes to 104. Tariffs no, goes to 90. And that the long and short of it is, I think it's not just silver. They were short platinum against long gold. Big short platinum against long gold. They were short silver calls. They were short platinum calls. I mean, this is from a bank trading desk. I'm not just like having an opinion on it. This is like what they said to me. And they had been buying gold options and financing it. They don't want to pay for anything. Buying gold options and selling silver options against it, and then bragging about it when gold goes up $300 and down $200 that they're making money in their gamma and silver's unchanged. Well, this is silver's revenge. In fact, it's platinum's revenge as well. And that's it. I think there's a grassroots movement again in the white metals. And I say white metals because it's kind of crazy because historically, when the PGMs catch fire for their own reason, let's say it's platinum or palladium thing, whatever's going on in those markets, you'll see silver rally too. And the lesson I learned was, why is that, from an old Goldman Sachs trader? And he said, well, it's white. He goes, well, who cares? It's a different metal. He goes, no, it doesn't. It matters to the people that are short. They're like, oh shit, I may have to cover my silver.
Yeah.
And you get
2021 Silver Squeeze stands as a compelling chapter in the evolution of retail investor influence, demonstrating how social media coordination could mobilize thousands of individual traders around a single commodity target. Veteran commodity analyst Vince Lanci witnessed this unprecedented event unfold, offering a professional perspective on how retail energy attempted to reshape a traditional commodity market. Born from the euphoria surrounding successful short squeezes in heavily shorted stocks like GameStop and AMC, the silver movement represented an ambitious attempt to transfer equity market tactics to the commodities space. Reddit communities, especially Wall Street Bets and Wall Street Silver, became the digital battlegrounds where strategy was debated and coordinated action was planned. These forums buzzed with analysis, encouragement, and calls to action that attracted thousands of participants who believed they had discovered a formula for market disruption. The logic driving the movement appeared straightforward to its proponents. By coordinating massive purchases of physical silver and silver-backed securities, retail investors theorized they could create artificial scarcity that would force institutional short sellers into painful covering positions. This strategy had proven devastatingly effective against specific stocks, generating enormous losses for hedge funds and creating legendary gains for coordinated retail traders. Let's get back to the video.
Chris is in the process of doing an institutional report. He wants to do a big report and present it to some institutions. And my basically the gold fix is on Arcadia Economics in the morning. And people get a chance to see that there. It's a great community, and I love those guys. I just haven't been able to stop by too recently. But Chris and I will talk frequently about the metals. He'll see something and say, is this that? And I'll say yes or no. And I'll see something and say, are you getting confirmation? You know, just basically two traders talking, you know. And yesterday, as he mentioned to you, he mentioned it to me, and he showed me the chart. And of course, we all pull up our charts, and the chart's like, oh, look at how basically the story is the net shorts are the second biggest they've been since whenever. And when they get this big, you know, give or take, when they get this short, silver generally tops out. And that's it. And that's just a small piece of the bigger analysis he's doing. And he showed me the data. And then I did a little bit of regression analysis, and the last two times are rememberable. We'll remember them. The last two times they were this short were, let's say, when the silver squeeze happened, they got really short, and then the market topped and came off. And in 2011 is easier to see, and 2011. Now the silver squeeze, for your younger viewers who aren't as old as me or even you, right? The silver squeeze ended with them getting extremely short, but that's part of their business. They're market makers who sell it as it rallies and buy it when it dips, but they got overextended, and the market just was like a snowball rolling downhill, gathering momentum, getting bigger. And on the highs during European hours, JP Morgan puts out a report saying, out of Europe, it says European miners are overvalued. And starting in Europe time, silver just collapsed. Yeah, it was 2021, right? That was right, exactly, the much ballyhooed silver squeeze. But it was just such, it reeked of panic, and only the really hardcore silver people saw it for what it was. And I also saw it But I'm like, oh, is it like they connect the dots in a way that I didn't? I'm like, oh, yeah, you know what? They're right. And so now going back to Chris's thing, so they get over. So here's what happened then in the silver squeeze. We'll do 2011 as well. 2021, the silver squeeze happens. JP Morgan puts out a bearish report on European miners, and that's the sign everyone piles on and the market craps out. This is after several margin raises, et cetera, et cetera. And so what happened when they got to this short point of being, let's say, too short or overexposed? A news item comes out after several margin raises. The market continues to defy the news item. I mean, not the news item, the margin raises. The news item comes out and the market drops. So the market goes like this. It goes up. They get too short. It goes up a little bit more. And then boom, it collapses.
The shifting dynamics between gold and silver highlight the underlying stress and adjustment in market positioning. While gold holds steady, silver's sharp move upward signals that traders may have been overly bearish on economic metals. Past episodes show that when silver lags too far behind gold and short positions become excessive, even a small change in sentiment can trigger a swift reversal. Silver's surge against a steady gold backdrop may signal deeper shifts in market sentiment. Is this the start of a broader move, or just a brief shakeout? Let us know in the comments, and don't forget to like, share, and subscribe.